recording.
Okay.
Oh, here, I'm going to stop recording.
Okay.
We are recording. And then I will hit mute on myself. So here we go. 5,
Okay.
4, 3, 2.
Hi, everyone. I'm Rick Bensignor, and this is our weekly In the Know Trader webcast. Well, stock markets are up again today. Lawmakers reaching a deal to prevent another government shutdown, potentially scheduled for Friday. And of course, we're seeing some optimism grow over a potential trade deal between the U.S. and China. And that's got the market up nicely today, almost 1% or so as we're recording this. As far as getting through what we're going to do today and take a look at the agenda, let me talk just a quick second about my upcoming speaking schedule. I will be talking at the Traders Expo in New York City on Monday, March 11th. So for any of you who are in the New York area or who can get there, it'd be a great thing to go to. I'll tell you, I just got back from Orlando, where I spoke at the Money Show down there. And the Money Show is, it's the same company that runs New York Traders Expo. It is a terrific conference. It gets hundreds, if not thousands, of people coming. And of course, one of the best things about both the Money Show and Traders Expos are they are free to register. They are free to attend. And this is a great way of getting some education from a variety of people in the industry who will teach you different models and different things they do that they use to be successful in the market. So if you're a trading-oriented listener and you can get yourself to New York City, it would be great. And of course, come up and introduce yourself to me, whether you're an In the Know Trader client from our website or an In the Know Trader listener on StockCharts.com. I always like meeting people who are our clients and you know, getting to put a face to people who I'm in touch with, often as clients or through email. So that's our upcoming speaking schedule. Today, two other things that we want to cover in the half hour we have together. I want to continue discussing and talking about Tom DeMark's sequential model. This is, again, an institutional model that is used a fair amount by big and small hedge funds on the street, as well as traditional mutual funds and pension funds. As we've said before, this is an institutional model. And in fact, I've gotten several emails from listeners from this webcast that we do each week for Stock Charts about the model and, you know, when will it be in Stock Charts? And I can tell you it will not be. This is a model that Tom DeMark owns, controls, and only puts on institutional platforms, and there's only two of them that it is available on. It's on CQG and it is on Bloomberg, and those are the only two places that it is accessible from. But the reason I teach this model to you is I use this in my analysis both for my institutional newsletter, which is done through Bensignor Investment Strategies, and then of course I use it too in the analysis we do every week in the Know Trader, which is my individual investor newsletter. And as I've said before, I created In the Know Trader to be able to give individual investors the same type access to institutional models that some of the big boys use on the street. And that's why we've spent the last few weeks going through this model. It is not codable on your own. There are too many nuances built into it beyond the basics that I'm explaining to you, because some people have tried to code it, and almost always they are unsuccessful at doing it because, again, there are things built into the model that are beyond the very basics. But we'll talk some more about that today, and then we'll finish our show looking at key charts of some markets that are moving and let's call them the important markets to look at right now, which will include the S&P, the dollar, and gold and oil, as these market and bond market, I think we'll be able to squeeze in too, because these are kind of the key markets that drive virtually everything else. So that's the agenda for today. So I'm going to switch and bring us to a chart here. This happens to be a weekly chart of gold, and we're going to use it again to kind of continue teaching sequential and also show you some variances of it, just so that you can understand there's more than one way of using the model and even identifying where the signals come up from. So I'm going to blow this up so it makes it a little easier to see. And let's, for instance, work on here. Let's look at this section, which goes back to, this is a weekly chart going back to 2016. So down here on the lower left-hand corner, this is the secular bottom in gold in December of 2015. This is when gold got down to about $1,045 or so, and then started its up move. So again, I'll quickly review some of the things that we've talked about over the last few weeks and then build in some new elements here. So the first thing that needs to be done to even get a sense that trend is in play is a particular price pattern that DeMark defined as the setup portion. It's the first piece of this model, and you've got to minimally move 9 consecutive price bars. In this case, it's weeks, because we're looking at a weekly chart. And in the case of a market moving higher, each one of these numbers coming across on top of the price bars shows that it closed on the Friday close above the close from 4 Fridays prior. Right? So the relationship here is 9 consecutive price bars that the close is above the close from 4 bars prior. DeMark defined this as the minimum of movement that needs to be done to define that a trend exists. After you do this setup count, if the market that you're looking at still moves in the same direction, in this case upward, it will continue to look for the ultimate exhaustion point of that trend. That's the red numbers that are showing up above price bars. And so after you do 9 consecutive price bars close above the close from 4 bars back, the software will then look for 13 price bars that need not be consecutive, that the close is greater than the high from 2 bars back. All right, so it's changed the rules. The setup, 9 consecutive price bars close above the close, 4 bars back, followed by 13 price bars need not be consecutive. In fact, when they are consecutive, I disregard the signal because the trend is too strong. So I like to see non-consecutive price bars. So 13 times that the close is above the high from 2 bars back. So bar 9 also met the rule of the first phase of the countdown. The countdown is the 13 bar count. So not only was this close, bar 9, above the close from 4 bars back, which was bar 5's close, but bar 9 also closed above the high 2 bars back, and therefore it also overlapped and started this 13 count. Bar 2, by being labeled as bar 2, easily shows that the close was above the high 2 bars back. Notice this is not bar 3, because this close did not close above the high 2 bars back, and none of these did in here until finally bar 3 gets labeled, because this close was above the high 2 bars back. And you can see that there are breaks in the count, and in the countdown portion, this red count, it is absolutely fine to have a break. Again, I actually prefer breaks. I don't want to see 9 bars followed by 12 bars all in the same direction moving straight up. That is usually not a signal that I'm going to want to take when this shows price exhaustion. Notice that there is a almost, this looks like 5-month period that gold was predominantly in a downtrend, but it did not stop the count from still existing. So for instance, here, bar 12, is the first time since back here at bar 11 that you finally had a close above the close 2 bars back. Now, some might say, if you've peaked and sold off this much, why is this still looking for exhaustion of an uptrend when you've been downtrending for 5 months? And it's a good question. And there are rules for when the software would stop looking for an exhaustion of an uptrend. And the 2 rules that would need to take place to have the stop counting, looking for exhaustion of this move that started here on the left back in late December of 2015, is if you had an entire price bar trade, the entire range of the price bar needs to trade beneath this dotted level. Well, where's this dotted level and what is it? It's called the TDST line, Tom DeMark setup trend line. It's the lowest low in the setup count, which is usually bar 1's low, but it doesn't need to be. Bar 2 could have a lower low, bar 3 could have a lower low, but it is the lowest low. So you would need to have an entire price bar trade beneath this TDST level to cancel the software from still looking for an exhaustion to this uptrend that started with the 9 count. There's another rule that also has to do with this that's too complicated to get into. It's a breaking of this trend line, but there's specific rules on how to close beneath this trend line. But essentially, it's kind of the same thing. You're going to have to get price action underneath the TDST line that started the whole up move in order to say that it's no longer looking for exhaustion to this 9 count. So the software, it's just software, it just does as it's programmed, found this to be bar 12. Now notice here, the bar after bar 12 is this large up move. Did this close above the high from 2 bars back? It did. So the question is, why isn't this bar 13 and the exhaustion point to the trend? Well, you'll notice that there's actually an asterisk above this price bar. In fact, there's lots of asterisks here until we finally get a 13th bar here, which is saying you're finally exhausting the uptrend that started all the way back in December of 2015. And what these asterisks mean is there's a filter built in to this model that says the 13th, the bar that gets the 13 signal. Hold on a second, because I'm seeing something that doesn't make sense. That's interesting. I perhaps even don't have the filter turned on myself, because this 13th bar actually doesn't even meet the filter. The filter says that the 13th bar has to at least have a range that intersects the bar 8's close. Bar 8's close is over here, and it's up at 1339, which is why there's a 13 here. I'm honestly not sure why this one's here. I'll have to look at my settings, but this 13 here is actually calling the end of this entire trend that started. And that's why all these asterisks are here to say, yes, it's closing above the high from 2 bars back, but it's not higher than bar 8's close. And therefore, this is really the 13 here. Again, I apologize. I've got to check. I may have a setting here that's off because this 13 shouldn't be here like that. Nonetheless, this 13, instead of being an asterisk, it actually gets the signal that this price bar right here closed above the high from 2 bars back, and we've now finally finished off this trend that started all the way in December of 2015. So now you've got a little bit more of the nuances that exist in the signal looking for exhaustion of trend. I will tell you another element here is that the 13th bar has its own rule, and it can close above the high from 2 bars back and get the signal, but there's a special rule here on the 13th bar that if it just opens above the high from 2 bars back, it will get the signal. So it's very possible that the opening of bar 13 already, if it's above the high from 2 bars back, will print a 13 on your screen, and you need not wait for the close of the day because of this special filter that exists on the 13th bar. So that's a piece and some more to things that we haven't discussed in prior weeks as we look more deeply into this model. One of the things that's really I love about this model, besides the fact that it can call exhaustion of a trend better and more accurately and closer to the absolute turning point of a trend, and it does so far better than RSI moving averages or any other model out there because it literally can pick the price bar that a trend ends on, is the element also of that TDST line. So while making and searching for the end of this signal that started back in December 13, other 9 counts showed up. And anytime you do a 9 count, that 9 count is also entitled to a 13 count should the market keep going in that direction. So there's a TDST line here that would be drawn, again, from the lowest low in the 9 count. And by the way, if the lowest low of the 9 count gapped up, it's going to draw the TDST line from the true low, or essentially the close the day before, as compared to bar 1, 2, or 3s, or whatever the lowest low is. And it often, look, if this is theoretically the potential beginning of a trend and the minimum price distance or price relationship that exists in order to have a trend identified, then where that trend started actually should theoretically be support. So whereas most technicians would say support's down here near 1120, this was the low of the move, a lot of times it's the TDST line that acts as support if tested. And you'll notice here in the middle of the screen, there's another 9 count that started. And that one's also entitled to its own 13 count unless we break beneath the TDST line or do a 9 count down. So in real time, there were red numbers here counting, looking for exhaustion of this trend. But because we ultimately did a 9 count in the opposite direction, 9 closes less than the close from 4 bars back, that kills looking for exhaustion of trend in the other direction, because now it says perhaps there's trend in the other direction. So that's one piece here to pay attention to. The other is the TDST line. Notice that we sold down from this kind of 13-9 combination and stopped right against the TDST line. In other words, the lowest low in the 9 count that moved higher. Whereas again, most technicians would say, oh, there's support here, 1200, 2 weekly lows here, 1 awfully close here. That's where the support is. Well, it never got down there. It actually stopped right against the TDST line. So we pulled back from 1350-ish down to 1240 before rallying again. So the TDST lines are important levels to look at too. Here we've done a 9 down. We went past the 9, so in real time, there were lots of red numbers here looking for a 13. It never got to a 13 before we turned around and did a setup to the top side. In other words, an upward setup. Once we got this 9 count here, that takes all the price bars away, or not the price bars, the numbers beneath the price bars away, so you don't see that there were red numbers looking for exhaustion of trend. Right? So a 9 count in the opposite direction kills the chance for an unfinished 13 to still be looking for a 13. That's something that's important and something new that we're teaching you today. Notice that just 2 weeks ago, we did a 9 count up against the TDST line that started the most recent downward 9 count. That's a resistance point. So again, whereas most conventional technicians would say that resistance is, kind of near 1360 up here, where you had this price bar back in the summer of 17 and all these highs in here. This model actually very nicely indicated where you would see resistance, which was 1326. And when we had gotten long gold, both for in the no trader clients down somewhere around 1220ish or so. Now for in the no trader clients, which is more of a tactical trading, we were out right around 1280. Institutional clients I actually wasn't long gold for, but did say that gold would target 1326. And I was targeting the TDST line here. The fact that it lined up with a 9 count often says that there's a pause in the market, and gold pulled back the last couple of weeks. It's at 1312 off of a high of 1325. So it's not off much, but we know 9 counts often can be pauses, and to me, especially against a TDST line. Here was a 9 count against a TDST line. We could have looked for a small trading bounce, didn't get it. And because of the rules that exist on how to break a TDST line, this one turned solid instead of dotted, which is the software's way of telling you it actually legitimately broke, and you can look for lower prices. And of course, gold sold off another $80 or so once it properly broke this TDST line. So we've gone through some new elements here today. Next week, I've got some more I want to show you on sequential. But we've still got about 7 or 8 minutes left. Let's go and take a look at some markets and kind of fill you in on what I'm seeing and what I think is going on in the market. So let's start off with, I almost always am going to look at the S&P 500 as the first thing we look at, because it is basically the most important index in the world, and therefore that's where we start. So currently, this is now a daily chart. You can see the nine here. Let's for the moment, we'll take off the cloud chart, make it a little easier to see. You can see we did a 9 count up. It's continued, and now we're just a couple bars away from potentially getting a 13 count, which looks like it could come in a few days. So I might very well start laying out hedges in a few days based upon that model. The green line is the 50-day moving average. We've passed through that. The pink line here, or a magenta colored line going all the way back, is the pretty darn flat 200-day moving average, which in here we kind of stopped against, and everybody on the street thought they were heroes by saying, oh yeah, we stopped against the 200-day. And the reality is, in factual information, yes, you stopped close to the 200-day. But what I'm going to tell you, I'm going to take the moving average away, is that more important than the 200-day moving average, which some institutions look at purely as a reference point, but very few actually trade off of, is that there are some other DeMark models here that we incorporate into our analysis that, as far back as the December low, already told us that we would expect to find resistance at 1668, which is slightly above where, I'm sorry, what am I looking at? It's not 16. Oh, there we go, 2738. So there's resistance here from one model. An unrelated DeMark model, where these green triangles are, also has a target point. So to me, it's more that the 200-day moving average happened to be there, as compared to the reason why things paused there a few days ago. Now, we did put out a quick flash note to institutional clients talking about the potential pullback from this target point that we had been talking of since early January. And instead of just saying the 200-day moving average, because many times, moving averages move, so a downward sloping one was going to have a lower price each day. It just so happened that the moving average, when I put it back up, you'll see was fairly flat. So it really hasn't moved in price. But our target was much more based upon these measurements that suggested that's where the target would be for this move. The other thing I want to do and show you is one of the other models we use, and I'll be talking about this model at New York Traders Expo. I infrequently do presentations on Ichimoku for individual investors. I usually save them for Traders Expo in New York. is this model, which many of you may at least know. This is available on StockCharts. It's called Ichimoku. In English, we translate this Japanese model's name into cloud charts. So this is a model available on StockCharts, and something that I will tell you, it's also one of the core models I use. You can look online for information about how to use this model. I will tell you that the mathematics that any of the online sites have about how to calculate the 5 lines that make up this model. The 5 lines are this magenta colored one, this orange one, this red one here, this green one here, and this bold blue one. Those 5 lines make up this model. So everybody's got the mathematics correct. What most people don't have correct is the actual interpretation of this model. And at some point, I'll more fully explain to you how that came about. But a lot of the information that's in English about this model is actually not accurate. And the first reference piece in English was not accurate, and therefore almost all the other books and articles written about this since then are also not accurate. I am considered the Western world's foremost expert in this model. I know exactly what's wrong with the interpretations. I actually don't put out a book on this because it's a huge competitive advantage to my clients that I know how to use this model, and so many people use it incorrectly, so it gives us a big edge. What I have said to my clients, again, this is both institutional and in the no trader clients, was how important this line here, this magenta line, was, and that even on minor pullbacks that we've seen, because so many people are talking about, technical resistance and how that we've moved up too far, too fast, etc., is that even last week, and I think it was Thursday of last week, when I put out the flash note to institutional clients, is that the pullback may go no lower than this line. And sure enough, that's all we did. And now we've come back, and even as I speak now, it looks like the S&P has just made a slightly higher high from last week's high. So this line has given us support. It's done the same. In fact, let's see if I have it here. Do I have J and K? Now let's add. Let me see if I can quickly add another chart. Here's, by the way, daily. J&K is the Barclays High Yield. This is the junk bond ETF that is very popular. Notice that it has been trading almost exactly with the S&P. Bottomed right around Christmas, caught all the lows here with this magenta colored line, which is called the conversion line, even last week's pullback. Now it's on a bar 12. The S&P is on a bar 11. And this looks like it could extend up towards 35 3/4 or so over the next few days. So that's a place we may get a pullback from. But to me, until you break this line here with any little oomph to at least next target this line, you still got a bull market. So you've got a bull market in junk bonds, and you've got a bull market in the S&P, which is getting closer to potential exhaustion points that we know. But so far, nothing's broken down. And even the cloud model has gone bullish in the daily time frame by passing through its cloud and the lagging lines through its cloud. So whatever pullbacks come, I still think are fairly minimum. We've got to wrap it up for this week. We'll be back next week. I'm Rick Bensignor, and thanks for listening to In the Know Trader.